Hi there, welcome to Kneppy Invest. In May 2023, about 3 months previous from when I'm recording today's video, I did a Kneppy's analysis on a company called Iress, a company I had never looked at before, and there were some red flags about the company, but there was also some interesting potential about Iress as well. Now, at that point in time, I was not willing to take a position in this company because simply I wouldn't consider Iress to be a high quality company. In fact, I'll go through my slide deck in a second. I would consider Iress to be a low quality company. And the only reason I'd hold this company is a trading position. Now, the company has released their half year results, not their full year results. We currently are in the closing auction. It's currently 4:06 p.m. Share price before the closing auction is down 34.9%, potentially down even further because the indicated price is at 6.31. Now, you have to update this all the time. Now, the indicated price is down to 6.30, so that means the share price down by more than 35%. So, I had a lot of choices to make in regards to what video I was going to record right now. Initially, it was going to be on A2 Milk. I was going to do a video on Breville, Ordinate, but I've decided to do a video on Iress because it is possibly the worst performing company on the ASX, including small cap companies. So we want to understand why the market is really bearish on this company on the back of their half year results. So before we have a look at the half year result investor presentation, I'm going to go back to my Kneppy's analysis slide deck and just discuss a few things about this company. Now, the first thing I want to discuss is this Rule of 40 benchmark. So this is their goal. Now, it's very important to note that the CEO and CFO are new in this company. They've recently changed. And that is the intriguing thing about this company moving forward, because I actually do like the CEO. And there is a possibility that this is the worst it gets for this company because new CEO has come in. And a lot of times when you do see a new CEO, that is the worst it is for a company. And that is possibly what's happening with Iress right now. So it seems like they are aiming for a Rule of 40. So they want their revenue growth and the EBITDA margin to be greater than 40 if you add those together. Now, the Rule of 40 definition is a little bit broad. I have seen different definitions, but the one constant when it comes to the Rule of 40 definition is revenue growth rate. I've seen some people use EBITDA margins, profit margins. I've also seen some people use free cash flow as well. And at this point in time, Iress is well below the Rule of 40. And we'll have a look at the revenue growth, which hasn't been a significant problem, but it has been a problem. But we'll also focus on EBITDA margins in today's video. I also discuss the CEO, which I have no problems with him. And when I do my Kneppy's analysis, I always talk about the quality of a company because I treat high quality companies a lot different than low quality companies. And when you look at the revenue growth, it actually has been decreasing 7.2% over the last 10 years. 5.2 over the last 5 and 3.8 over the last 3. That is concerning in itself, that the revenue growth, and that's per share, has been decreasing over time. Now, Iress has been on the ASX since 2000, so it has been a listed entity for over 20 years. The other thing I look at is return on invested capital. And at that point in time, when I recorded this video, return on invested capital was 9.3. And the concerning thing for me was return on invested capital has been dropping just like revenue growth. And total returns over the past 10 years, so that's share price movement plus dividend, was only 5.9% per year, which is on the low side. In fact, if you rated all the companies based off their total return over the past 10 years, Iress would be near the bottom, not near the top of companies on the ASX. So I said and described this company as a low quality company and I only trade it. That's the only reason I would buy this company. I think that's all I want to talk about when it came to my slide deck. Oh, the other thing I want to talk about was this, very important, little graph, what do you want to call it, which shows you the total revenue. This is not revenue per share, but total revenue growth over the past 10 years, but also gross margins and operating margins. So the first thing I always look at when I'm analyzing a company over time is whether the company can grow revenues. And Iress has not had that problem. So revenue have grown from 251 million to 618 million over the past 10 years. But the very extremely concerning thing about Iress during this 10-year period is that the gross margins and operating margins have fallen. Gross margins have dropped from 38% down to 28% in the most recent financial year. So want to pay attention to gross margins and operating margins, EBITDA margins for this company, because they have been dropping. And this is a concerning sign. It shows potentially they don't have competitive advantage over their competitors. They don't have a moat. They don't have pricing power or those sort of things. I think that's all I want to talk about. Dividends, yeah. Valuation, PE ratio of 37.2. So straight away, that looks quite expensive for this company that's pretty, I won't say dodgy, but definitely not high quality. And I did a reverse DCF, and I said this company would have to grow at would have to grow their earnings per share at 21.3% per year to justify the current valuation. And I don't think I say this when I talk about reverse DCF. To justify the current valuation, that means I want a return of 11% per year. So they'd have to get that 11% per year in earnings or return, they'd have to grow their earnings per share at 21.3% per year. And that's not including dividends, by the way. So anyway, closing auction has been completed. Let's switch. So share price down 35.5%. So that indicated price at 4:06 p.m. was not an indication, a true indication where the share price might fall out. Sometimes it is close, but sometimes people, institutions play funny things with the buyers and sellers to make it seem like the share price is going to drop a significant amount or rise a significant amount. But still, a share price dropping 35.5% in one day is not a good thing. Now, another thing I'm going to do is show you the chart of this company, and I'll do that right at the end of the video. So let's have a look at the half-year results. Why? And this is just the presentation. So I just want to do this fairly quickly. I did actually write down all the pages I want to look at, because there is, how many pages? 34 pages. So talk about themselves, listed on the ASX since 2000. In fact, this overview, they actually have the Rule of 40 on the right-hand side. It's a key benchmark for success. And at this point in time, they're nowhere near that Rule of 40, but this is more than likely a new strategy by the CEO, because he's just come on board recently. Also, maybe the CFO and CEO have decided they have to aim for that Rule of 40. So first thing I will look at is nothing that is said by Marcus Price, the CEO and Managing Director. We can judge his performance in a few years, not right now. So let's have a look at the first half financial year performance. First half of financial year 23 performance. Reported revenue up 2%. So remember, over the last 10 years, revenue has been dropping. Now, this is just first half year results. There could be some cyclicality to this company, but they are comparing to the first half of financial year 22. The very fact their reported revenue is only up 2% is the first significant red flag. We want to see more revenue growth than that. But even more concerning is the margins. Underlying EBITDA and margin down 17%. From 71.9 to 59.5. Underlying profit down 31% because of dropping margins from 35.2 to 24.4. The reason they're using underlying is because they do have a write-down or an impairment, which means their reported profit is actually negative. I think it's negative something like 130 million or something like that. Underlying earnings per share down 29%. So even though they are loss-making, these are still, and these are just underlying, these are still very concerning numbers. So underlying earnings per share down 29%, reported EBITDA and margin down 55%, and reported profit down 557% from 30.6 million to negative 139.8 million because of that impairment of UK goodwill. I typically ignore when there's ever an impairment. That's just a one-off. That's not a true indication of how this company is performing, but these underlying numbers are really concerning. So of course, they talk about challenging business conditions. And strategy update, I pass through all this. Then we get the CFO talking, Cameron Williamson, who was a CFO at Pendle Group for 14 years. So he has a lot of experience. And the next thing I want to talk about is a financial results summary. So we already know about this, but operating costs up 8%. So revenue up 2%, operating costs up 8%. And this is why the company's profit or underlying profit, underlying EBITDA are down. Share-based payments up 16%. Underlying EBITDA margin went from 23% down to 19%. So if they want to achieve or wanted to achieve Rule of 40, they would have had to have grown their revenue by 21% in this half year. So still, yeah, so far we can understand why the market has punished Iress today. The next page I want to look at is 14. Oh, this is just a cost breakdown. Why have the costs increased by a greater amount than their revenue? So $8 million increase in technology platform costs, platform interest charges, $7 million because of increased salaries, higher contract staff supporting product improvement initiatives, $5.1 million increase in software and licensing costs, and there was a slight benefit of FTE costs. So significant increase in costs, and that's one of the reasons why this company had a bad half year. Now on to cash flow and balance sheet. One thing I haven't mentioned in the free cash flow is dividends. Now, this is probably a main concern when I looked at the cash flow statement of this company, I think we can actually see this in the next slide. So I won't talk about dividends just yet, but free cash flow before capital management fallen from 40.5 million to 20.7 million. Operating cash flow falling from 74.7 million to 57.8 million. So that's concerning as well. Balance sheet, really concerning here. Net debt increased by $50 million to 375.8. Debt to equity increased from 90% to 165%. Leverage ratio from 2.2 times to 2.8 times. Now onto the capital management under review. I might just zoom in here. So this is interesting. In the way I look at it, capital allocation is very important. One of the most important jobs management of a company has to do. So they have to decide what to do with the money coming into the business. Do they give that money back as dividends to their shareholders? Do they make acquisitions or research and development? So this is a part of capital allocation, capital management. So free cash flow, and this is the last 4 years they've shown here. So they're showing free cash flow on the left, total dividend payment in the middle, and net debt on the right. So two really concerning things. The first, maybe even the middle, the total dividend payment is a little bit concerning as well. So free cash flow has been dropping each and every year over the past 4 years, from $91 million to 20.7 million in this half year. And in fact, this was the worst half year this company has seen over the past 4 years. Now on the right, we have net debt increasing from 48.7 million to 375.8 million. They also announced they have sold something MFA, so that will decrease their debt, but it is concerning that they feel the need to sell assets to decrease their debt. Now, the other minor concerning thing is they haven't changed their dividend payouts. So overall, 85.9 million in financial year 22. I'm not sure if they have mentioned any dividends yet for this half year. They did mention in the capital management plan in February 2024, they will address dividend policy. And it possibly, I haven't looked at this yet, possibly they might stop the dividends, because I did have a look at the cash flow statement and actually had to increase the debt to pay dividends to the shareholders because they don't have enough cash coming in. And this happened over the past 2 years. So that is concerning. So that's a reason why you probably like to see dividends being paid out to the shareholders being stopped right now. It's probably, interim dividends suspended. Okay. So that actually is a good step in the right direction for this company. It really needed to stop that dividends because they actually increased their debt again to pay dividends back to the shareholders. I hate companies who do that. It's bad capital management, really, really bad capital management. If you don't have enough cash, why would you keep giving your shareholders cash? Outlook, 2 things I want to say. So here's a pathway to Rule of 40 in core business. So let's have a look at the financial year 24 outlook. So underlying EBITDA growth of 5 to 10%. So whether they can achieve that is up in the air right now. But if they can achieve that, and if they can get to this Rule of 40, this company might be looking cheap right now. Financial year 24 underlying EBITDA exit rate 20 to 30% higher than financial year 23. Again, remains to be seen if the management can achieve these goals. But this is new management, and we have to give them the benefit of the doubt. As I said before, I do like the CEO. And by the end of financial year 25, core Iress business operating at Rule of 40. And again, if they can achieve that, I think this company is looking interesting. Significant debt reduction. That's very important too. So they are concentrating on things I like to see. Debt reduction. They have suspended dividends. So everything's looking good. And 20. Why did I want to look at this? Okay. So where we are today, first half results represent 0. in time. So they want to make this clear. This is just what's happening now, but is not representative of the potential of this company, not reflective of potential. But that remains to be seen whether this company can achieve their potential. Where we're headed, laser focus on transformation, 2023 and exit rate, or in 2024 exit rate improvement. Again, talking about rule of 40. Further update to provide an investor update in second half 2023 and further update in 2024. And then they go through an appendix. You can look at they'd have different, where is it? They have exchange rates, segment performance. So they have quite a few segments. So if you really want to look at that, I would recommend either going to the financial statements or have a look at their presentation. Now onto the chart. I have to bring the chart up here, so just hang with me for a second. Okay, so this is the weekly chart for Iress going all the way back to 2012. And the reason I want to go this far back, even though this company is listed in 2000, was because the share price of Iress in 2012 got down to $6 for a very brief period of time. Share price then went into an uptrend, and the really strong, important support level for this company over the past 7 or 8 years has been $8.50. We have seen the share price test that level a couple of times in the past, particularly 2 times in the past 2 years, and that share price has supported this company. Well, we should say that the market has supported the share price of this company at that level, because whenever the share price got to $8.50, we saw the share price bounce. Now, on today's financial results, the share price has fallen well below $8.50 and is currently around about, what was it, $6.44, which means the last time the share price was $6.44 was way back in July 2012. So we're talking about a 10-year low for Iress share price. So just looking at the weekly chart, it looks very bearish. But if you are a believer of the new CEO and CFO, now might be a time to think about taking a position. But heaps of negative sentiment in this company right now. The share price could fall more from here. Might not. Really interesting trading today. I had a quick look at this. So we look at a 5-minute chart for Iress just today. A lot of volatility. So day traders will be loving what's happening in Iress. So just sort of zoom in a little bit. So in fact, the share price opened today down 30%. Share price opened at $6.76. In the first 20 minutes of trading, there was a pretty big bounce on massive volume. Share price actually increased 6.5% in the second 5-minute period, a further 7.2% in the second 5-minute period, and then a further 1.4% in the following period. And the share price actually bounced all the way back up to $8.15. $8.15, just shy of that old support level, which is now resistance. But that was the end of the buy. So fortunate for those people who bought right on open, they could have sold out a pretty big profit after only 20 minutes of trading, because during the rest of the day, the share price drifted down and down and down. In fact, the share price went below the low on open and is now the low of the day, which is actually a really bearish signal. When you do close at the low of the day, that's not a good sign. In fact, the one-day candlestick is a really bad one-day candlestick. I think that's what that's called. There is a name for that sort of one-day candlestick where you have the main body and there's a massive shadow above the body. So a lot of selling did come in today. Very bearish one-day candlestick. Huge volume as you would expect. If I would say, without any, for some reason this is really slow. For some reason, that is probably the highest volume we've seen in a long, long time for Iress. And yet it's really slow for some reason. Not sure why. I'm just looking at the volume. I'm going all the way back to 2020, and the volume today dwarfs what we have seen in the past for this company. So anyway, I think that's all I'm going to have to talk about in regards to Iress today. Our video went on a little bit longer than I was anticipating, about 20 minutes long, but it's okay because a lot to think about when it comes to Iress and a potential, just a potential at this stage, a turnaround story in the future because, again, a new CEO, new CFO, they do have some goals. If they can achieve those goals, within the next 2 years, this company would be looking interesting. But again, a lot of questions about the path this company is on right now and whether the new CEO and CFO can actually turn business around for this company. So if you do have any questions about Iress, I'd love to hear your thoughts. So leave those in the comment section of this video.